I'm about to share the most idiotic mistakes I made with my first Section 8 house. And you've probably heard the common ones already, like always do a home inspection and don't overpay for a house, but I already knew these, and I still made a lot of dumb mistakes. These mistakes costed me tens of thousands of dollars, and they are the difference between having an actual passive income rental from one that's just a headache. And by avoiding the mistakes I mentioned in this video, I managed to go from $0 to a $1.9 million real estate portfolio by 21 years old. And I'm about to show you over the next 10 minutes exactly how to scale past 2, 3, 5, even 10 properties and get pure financial freedom through Section 8. 99% of new investors overlook this crucial factor: weather. Let me walk you through exactly what happened with one of my earlier deals, an $80,000 Detroit single family home. So it was a 3-bed, 1,100 square feet, and I thought it was honestly just an easy slam dunk opportunity. Solid layout, decent curb appeal, and a rehab estimate of around $10,000. I figured we'd just knock it out in 2 weeks, list it, and then get a Section 8 tenant within another 2 weeks. But here's what actually happened. We ended up finishing the closing of the property around late October, and I was assuming there would be a quick turnaround. 1 week into the rehab, temperatures plummeted. I'm talking like 20 degrees Fahrenheit. And then there was snow, and then there was ice, and then there was delayed contractors, and then there was frozen pipes. So that 2-week rehab ended up becoming more like 2 months of headaches, half-finished repairs, crews literally sitting idle because they couldn't work in freezing cold temperatures. At first I thought, okay, just a small delay, a small hiccup. But every week vacant ended up adding more costs. Holding costs added up. I mean, I had a mortgage, I had insurance, I had taxes that I had to pay on this property while it was still generating literally $0. On top of that, there was a huge material surge in price because there was a lot of demand for and little supply due to the cold weather. I even had to pay extra just to get contractors to show up in bad weather, and some still canceled last minute. And then inspections got pushed back, which even set my tenant placement further back. So in total, this winter delay cost me about $10,000 extra. I hadn't even placed a tenant yet. So my projections of the cash flow of the property and the ROI on the investment were completely destroyed. When it's snowing out, when the holidays are coming, when it's 20 degrees, only the absolute desperate are looking to move. So this means not only was my tenant pool smaller and lower quality, but I couldn't even find anyone who wanted the property until I dropped the price. So here is the solution. I feel like this one is super obvious, but simply avoid buying in those northernmost states bordering Canada between the months of October to March. So that includes places like Michigan, Ohio, Illinois, even upstate New York. And if you must buy in winter, let's assume you're halfway through a deal already, you can expect the property to either rent for $200 less on average, or you're going to have to wait out the weather. You should also be building in a weather buffer when creating your initial rehab schedule. You should automatically assume everything's going to take twice as long in the winter. I'm talking twice as long for inspections, for rehab, sometimes even closing. This is a smaller tip, but make sure you secure contractors before you even finish closing on the property. And this is more so just to get you up and running and, hit the ground running in order to do the repairs as fast as humanly possible. And always budget in around 15 to 20% higher than what you think for winter rehab costs. Again, it's just a cushion that you will almost inevitably use in order to secure your property through the winter. But again, it's so much easier to prevent these situations from happening in the first place than it is to correct your mistakes, aka just buy in southernmost states. But that's a little bit vague. What states? What cities in those states? There's actually a custom strategy that I use to find these up and coming cities that the average person can invest in. So if you're interested, check out my free school community where I have over 900 investors who are learning these exact strategies without making the same mistakes that I did. I host a free live Section 8 masterclass every single week where I share the exact system that I used in order to pick cities, avoid these mistakes, scale my portfolio, and I even give away free resources that I typically only reserve for my mentorship students. Click the link in the description to get access. After our rehab was complete, I made another critical mistake that so many Section 8 investors fall into, which is pricing the rental too high because you're only looking at the FMR fair market data. Because at the time I thought I was being smart. The house was freshly renovated, right? I bought in a high demand area, and HUD's fair market rent data said that I could charge $1,550 for a 3-bedroom unit in that zip code. So that is exactly what I did. I figured, oh, why not start the price at $1,550? That's the maximum. If no one bites, I'll just drop the price week after week. Spoiler alert, that was a terrible idea. Because here's what actually happened. Week 1, no applications, no showings, no calls. I thought this wasn't a big deal. I kind of just ignored it. Week 2, a few from tire kickers, but nothing serious. So I lowered the price by $50 to $1,500. Still nothing. Week 3, complete crickets still. I lowered the price another $50 to $1,450. Week 4, I lowered it another $50. Now we're at $1,400, which I thought was insanely low, but guess what? Still no calls. Why? Well, it was because it was extremely cold outside. It was 20 degrees, and this average home had now been sitting on the market for 30 days. Clearly, something was wrong with it, or at least that's what people on Zillow thought whenever they looked at my listing. What I didn't realize is that the Section 8 demand in my area did not line up with what the FMR chart said on paper. So $1,550 might have been the maximum that the government would possibly pay for an area, but it wasn't what landlords were actively listing their rentals at, especially for homes like mine, which were pretty average. Meanwhile, every extra week of vacancy meant more mortgage that I had to pay without money coming in, utility bills piling up because I had to keep the lights and the heat on, a growing risk of the property being vandalized, especially because these neighborhoods are typically lower income, and worst of all, the little nagging sensation in my head that constantly was saying that I bought a bad investment. I ended up lowering the price all the way to $1,200, and then the applications were coming in. By then, I had lost almost $3,000 in potential rent and spent even more in carrying costs. The solution? Set the rent correct from day one. You should stop relying on HUD's FMR numbers. They're helpful just to see what the maximum is in the area, but they don't tell the full truth. Instead, you should go to affordablehousing.com or Zillow and look up actual listings in your area that are the same type of home that you have and see what they're priced at. And be honest about how your unit stacks up against those. Because if similar 3-beds in the area are renting for $1,350 and they're getting scooped up within 2 or 3 weeks, then don't list yours at $1,500 because yours will sit vacant. With real estate, speed beats greed. 1 month of vacancy is worse than lowering the price $100 for a year. And by the way, you can always just raise the rents later. Section 8 allows for annual rent increases, and if you keep your property in good shape, the housing authority will usually approve them, but you can't get your time back because every day vacant is money lost. Plus, you can also just have the lease expire in spring or summer, so that way you can relist it at those normalized higher rents. Moving on to mistake number 3. When properties sit vacant, they become targets. And this is especially true in certain neighborhoods where Section 8 is often located, lower income. So after the delays and the overpricing of my Detroit property, I found myself in a terrible situation. A fully vacant, fully rehabbed home, just sitting there empty, completely vulnerable. But I kept thinking, okay, it's just a few more days, right? It's not a big deal. But in certain neighborhoods, a vacant house is essentially just a sign saying, please rob me of everything I have inside. So here is what happened next. One morning, our property manager came in to take some photos and noticed the window had been smashed in. The kitchen appliances were gone, and even the water heater and furnace were taken from the basement. That total loss was about $6,000. And worst of all, I couldn't even file an insurance claim because I hadn't notified my insurer that the property was sat vacant for more than 30 days. Because guess what? They only cover it up to 29 to 30 days. Past that, you need vacancy insurance, which I did not have. So that one mistake added a whole nother month of delays. We had to repurchase and reinstall everything. Repair the door, install security cameras, even put up security signs in the front lawn until a tenant was placed. So here's what I do now to protect my investments and what you should do as well. Install security cameras literally the day you close, because even fake ones can help deter theft, but I typically use real ones, honestly. I use the cheap ones you find on Amazon that like Amazon sells, Wise sells, the ones that just are $30 and connect to your phone app. I also put up those smile you're on camera signs on the front and back lawn because criminals tend to look for the easy wins. so visible security makes your home a lot less of a likely target. Also, get vacancy insurance if your property is vacant for more than 30 days. Most regular policies, including what I had, don't cover theft or vandalism during extended vacancies unless you notify them in advance or you switch plans. You should also ask your contractor to check in every few days or use motion sensor lights to alert you via app if there's any movement after dark. And on all entry points of the home, add smart locks. These are the type of deadbolts that you just put in a little code and it unlocks the door for you. So that way nobody can steal your keys. And after a tenant moves in, you can simply just ask them to change the lock to whatever they want it to be. The cost of a Ring camera, maybe a few security cameras, and a small sign is gonna be $150 total, but the cost of getting hit with a break-in is guaranteed going to be thousands of dollars. But avoiding mistakes is only half the battle when starting to invest in Section 8 properties. How do you find those crazy deals that you only see in veteran investor portfolios? That's exactly why you need to learn this new strategy I have implemented recently with mine and my clients' portfolios that have built huge passive income through Section 8 rentals. So if you are ready to start buying cash flowing Section 8 properties the right way immediately, check out this next video on screen where I'll show you what you'll learn, how to get started, and how I use this information to go from $0 to over $1 million portfolio. As always, I'm Joseph Khateri. Have a nice day.